If you have more than $10,000 sitting in a bank account right now, the IRS already knows it's there. What most retirees don't know is that a reporting change taking effect this year changes what your bank is required to tell them, and what that means for your taxes, your Medicare premiums, and potentially your Social Security benefits. This video is specifically for retirees living on a fixed income, not investors, not business owners, people who worked for decades, built up some savings, and are now being quietly pulled into a reporting system they were never told existed. By the end of this video, you will know exactly what your bank is reporting. To the IRS, what triggers an automatic flag on your account, what actions can accidentally look like tax evasion even when they aren't, and the one document you need to review before the end of this month. If you get this wrong, the consequences aren't a letter. They're an audit, a premium increase, or a benefit reduction that stays in place until someone corrects it. And SSA is not going to call you when that happens. Most people have heard the number $10,000 in connection with banks and the IRS. Almost nobody knows what it actually means. And the misunderstanding is costing retirees real money and creating real legal exposure. Here is what the law says. Under the Bank Secrecy Act, any cash transaction of $10,000 or more in a single day must be reported by your bank to the Financial Crimes Enforcement Network, FinCEN, using a currency transaction report or CTR. This is automatic. Your bank files it without telling you. You do not sign anything. You do not receive a copy. It simply happens. The IRS receives access to this data. Now here is the part most retirees get wrong. The $10,000 threshold is not just for a single withdrawal or deposit. It applies to multiple transactions in a single day that together add up to $10,000 or more at the same institution. A $6,000 withdrawal in the morning and a $5,000 withdrawal in the afternoon. Same bank, same day. Triggers the same report as a single $11,000 withdrawal. This is not new law. It has been in place since 1970. What is new, and what is changing in 2025 and into 2026, is the enforcement priority attached to it. The IRS has increased its audit staffing specifically targeting discrepancies between bank reports and filed returns. Retirees with savings accounts, CDs, and money market accounts are disproportionately showing up in those discrepancies. Not because they did anything wrong, but because they don't know the rules and their banks aren't explaining them. If you have made any cash transaction of $5,000 or more in the last 90 days, withdrawal, deposit, transfer to a family member, write down the date, the amount, and the reason. You may never need that record. But if the IRS asks, the worst position to be in is not knowing what you moved or why. Structuring. The mistake retirees make without knowing it, there is a federal crime called structuring. It carries a fine of up to $250,000 and up to 5 years in prison. Thousands of retirees have come within range of it without any intention of breaking the law, simply because nobody told them it existed. Structuring means deliberately breaking up transactions to stay below the $10,000 reporting threshold. If you withdraw $9,500 one day and $9,500 the next because you want to avoid paperwork, that is structuring. It does not matter that the money is yours. It does not matter that you're not hiding anything. The act of keeping transactions below $10,000 to avoid a CTR is illegal. The IRS and FinCEN don't need to prove you knew about the reporting rule. They only need to show that you are aware of the threshold and acted to stay below it. Awareness is enough. Here is where retirees get caught. They hear about the $10,000 rule. They decide to keep their withdrawals under it to avoid triggering something they don't fully understand. That decision, made out of caution, not concealment, is the violation. The most common scenario: a retiree wants to give money to a child or grandchild. They know large cash transfers can create questions. They make several smaller transfers over a few weeks instead of one large one. Each transaction is under $10,000. Each one is legal on its own. Together, if the pattern shows intent to stay below the threshold, it qualifies as structuring. There is a second scenario that catches retirees with CDs and savings accounts. When a certificate of deposit matures and the retiree withdraws the principal plus interest in stages, specifically in amounts under $10,000, specifically within a short window, It can look like structuring to an automated flag, even when it isn't. The flag doesn't know the difference. The audit that follows does not wait for an explanation. If you are moving money in amounts under $10,000 specifically because you want to stay under the reporting threshold, stop, make the full transaction, let the CTR file, and keep a record of what the money was for and where it went. The CTR is not the problem, the pattern of avoiding it is. If you have already made a series of transactions that look like this, write down the legitimate reason for each one now. Before anyone asks, a clear record of intent is your only protection if the pattern gets flagged. The 1099-INT and what it does to your Medicare premium. Every year your bank sends a 1099-INT to the IRS if your account earned more than $10 in interest. Most retirees know this. What most retirees don't know is what that 1099-INT can do to their Medicare Part B premium and by how much. Medicare Part B is income-based. The standard premium in 2026 is $185 per month. But if your income crosses certain thresholds, called IRMAA, the income-related monthly adjustment amount, your premium goes up significantly. Here are the 2026 thresholds for a single filer. Income above $106,000. Premium increases to $259 per month. Income above $133,000. Premium increases to $362.60 per month. Income above $167,000. Premium increases to $466.20 per month. These are not small differences. Going from the standard $185 to $259 is an extra $888 per year. If that premium increase stays in place for 5 years, that is $4,440. Over a 20-year retirement, a single income threshold crossing costs $17,760. And it stays elevated every year that your income stays above the line. Now here is what changes when you have a savings account over $10,000. If your savings are sitting in a high-yield account, a money market, or a CD ladder, common choices for retirees who are correctly told to keep cash liquid and safe. The interest income adds to your MAGI, your modified adjusted gross income, for Medicare purposes. It does not matter that you didn't spend the interest. It does not matter that you rolled it back into the account. The IRS counts it. Medicare uses it. In 2026, a 12-month CD at a competitive rate on a $50,000 balance generates approximately $2,000 to $2,500 in interest income. On its own, that rarely crosses the IRMAA threshold, but combined with Social Security, a small pension, and any investment income, the number adds up faster than most retirees expect. The trap: your Medicare premium is calculated using your tax return from 2 years ago. The year the income occurred is not the year the premium adjusts. Many retirees are paying elevated premiums right now, based on interest income from 2023 or 2024, a year when CD rates were significantly higher than they had been in a decade. And they have no idea why their premium went up. Pull your last 2 years of tax returns and look at line 2B, taxable interest income. Add that to your total income and compare it against the IRMAA thresholds above. If you are close to a threshold, within $5,000 to $10,000 of one, talk to a tax preparer before the end of this calendar year. There are legal options for managing interest income before it hits your MAGI. Once the year closes, the income is locked in, the tax return is filed, and the Medicare premium follows automatically 2 years later. There is no appeal process for income you legitimately earned. The only window is before the year ends. If you are already paying an elevated Medicare premium and believe your income has since dropped, you can file Form SSA 44 to request a recalculation based on a more recent year's income. Download SSA 44 at ssa.gov or pick it up at any Social Security office. The bank reporting expansion and what it means for retirees. For the last several years, there has been a proposed IRS rule that would require banks to report the total annual inflows and outflows of any account with more than $600 in transactions. It has not passed, but a narrower version of expanded reporting is already in effect, and it specifically affects retirees with savings accounts and investment accounts above certain balances. Here is what is currently in place. As of 2026, banks are required to file a suspicious activity report, ASAR, for any transaction or pattern of transactions that the bank determines to be suspicious, regardless of the dollar amount. The threshold for filing is not $10,000. It is judgment-based. Banks file SARs proactively because failing to file when they should have exposes them to federal liability. What counts as suspicious is broadly defined. It includes transactions inconsistent with the customer's known history, large movements of funds shortly after account opening, regular cash withdrawals that don't match a known income pattern, and transfers to accounts the bank doesn't recognise. For retirees, this creates a specific problem. A retiree who has kept $20,000 in the same savings account for years, then withdraws $15,000 to pay for a home repair, a grandchild's college bill, or a lump sum to a family member. That is a transaction inconsistent with prior account behaviour. The bank's automated system may flag it. A SAR may be filed. The retiree will not be told. The SAR goes to FinCEN. The IRS has access. Again, this is not new. What is changing is the sensitivity of the automated systems. Banks have upgraded their transaction monitoring software significantly since 2023. Thresholds that previously required human review are now being flagged and filed automatically. Retirees who have held accounts for decades and have established patterns are running into flags when those patterns change, even when the change is completely legitimate. If you are planning a large withdrawal or transfer, anything above $5,000 that is outside your normal pattern, call your bank first. Tell them what the transaction is for. Ask them to note it on your account. This does not prevent a SAR from being filed, but it creates a record at the bank level that the transaction was explained and disclosed, which significantly reduces the likelihood of escalation. If a flag does occur, you are not required to explain your transactions to your bank, but taking 10 minutes to make that call is genuinely the simplest thing you can do to avoid a problem that could take months to resolve. The one document to review. Before the end of this month, everything in this video comes back to one document. Most retirees have never looked at it. The ones who have looked at it have rarely looked at all of it. And the errors it contains, when they exist, are costing people real money every single month. Your Social Security statement is available at ssa.gov. Log in or create a free account and pull your full earnings record. On Brightsibon, every year you worked, the income SSA has on file for that year, and the benefit estimate calculated from it. Here is why this matters in the context of bank accounts and IRS reporting. Your Social Security benefit is calculated from your 35 highest earning years. If there is a year in your record where your income is wrong, too low because of a payroll error, missing because an employer never filed correctly, or incorrectly zeroed out, your benefit is lower than it should be, permanently lower. Every month you receive less than you earned. The IRS now has more complete income data than at any previous point in its history. If your SSA earnings record doesn't match what the IRS received from your employers over your working life, that discrepancy is now more visible than it has ever been. The IRS is not going to correct it for you. SSA is not going to find it. The correction requires you to request it. There is a window. SSA can correct earnings records, but the process becomes significantly harder the older the error is. Documents from employers that no longer exist, payroll records from the 1990s, these take time to locate and verify. The correction is still possible in many cases, but it requires the right form and, in some cases, a formal review. Go to ssa.gov and pull your earnings record today. Look at every year you worked and check the income figure. If any year shows 0 when you worked that year, or shows an amount significantly lower than you remember earning, write it down. To request a correction, call the Social Security Administration at 1-800-77-21213 and ask specifically about correcting an earnings record discrepancy. Have your W-2s or tax returns from that year available if you have them. If you don't have the documents, SSA can request verification from the IRS directly, but you have to initiate the process. They will not do it without your request. If your earnings record is correct and your benefit is still lower than you expected, ask SSA specifically about whether any windfall elimination provision or government pension offset is being applied to your record. These two rules alone reduce benefits for millions of retirees who were never told they applied.